Chapter 10, Financial Markets, Allocating Financial Resources. So a financial market is any marketplace where buyers and sellers participate in trading assets. These markets can be found in every nation, but the biggest exchanges are the New York Stock Exchange and NASDAQ. And although these two exchanges are the biggest, they operate very differently, and the types of equities they deal with also differ. So in this chapter, we're going to be taking a deeper look at financial resources. We'll be taking a look at the role of financial markets in the U.S. economy and identifying the key players in these markets, identifying the key laws that govern the way financial markets operate and explain the impact of each law. We'll describe and compare the major types of securities that are traded in securities markets. I'll explain how securities are issued in the primary market and traded on secondary markets. We'll take a look at comparing several strategies that investors use to invest in securities. And finally, how to interpret the information that is provided in the stock quotes that are available on various financial websites. So, financial markets in the U.S. economy. Very broadly, financial markets refers to the transfer of funds from savers to borrowers. And those borrowers may be businesses. And, so what happens is you have what's called depository institutions. And companies and or consumers can get funds by accepting checking and savings deposits or by lending those funds. And some companies that are able to provide that type of can help facilitate those transactions. We have commercial banks, we have credit unions, and we have savings and loan associations. So if it weren't for financial markets, companies would find it very difficult to fund their operations. They need money to meet payroll. They need money to invest in their infrastructure. They need money to work on product development and to fund, competing in the global market. And it's these depository institutions that help facilitate this. Now, some other types of financial institutions that are also in the market are called non-depository financial institutions. So these are other financial intermediaries that play an important role in financial markets. They include institutional investors, and this is where they amass financial capital and acquire a portfolio of different assets. You have securities brokers. So these folks act as agents for investors who want to trade in financial securities. You have securities dealers. These are folks that buy and sell stocks and bonds for their own account. And then you have investment banks, and these help firms issue new securities to raise financial capital. Now, during the 20th century, the federal government responded to several financial upheavals by introducing new laws and regulations. In 1913, the Federal Reserve System was created, and it serves as the central bank in the United States. And its primary responsibility is overseeing the nation's banking system. So they're frequently referred to in the news as the Feds. In 1933, the Banking Act was created, And it's also known as the Glass-Steagall Act, and it established the Federal Deposit Insurance Company, or FDIC. And what the FDIC does is it insures depositors against financial losses when a bank fails. And as of today, for each account that you hold in a bank, you are guaranteed to get your money back up to $250,000, should you have that much in there. It also banned commercial banks from competing with non-depository institutions. So these two acts were really important acts of legislation that served to help protect both consumers and businesses from unfair practices. Now, during some other acts that we have, so we have the Securities Act of 1933, and this act was put in place by Congress, and they were primarily put in place as a response to the stock market crash in 1929, which is when the Great Depression took place. The Securities Act of 1933 dealt mainly with the process of issuing new securities, and firms, as of 1933, firms are now required to issue new stock in a public offering. And when they do that, they have to file a registration statement with the SEC. So it has to be fully above board and public. And then the Securities Exchange Act of 1934, this legislation came about to regulate the trading of previously issued securities. And the Securities and Exchange Commission is the group that was created as a result of this, and they oversee the entire securities industry, the exchange of stocks and bonds and treasury bills, all that trading that happens, they oversee that. So during the 1980s and 1990s, we saw a period of deregulation. In 1999, the Financial Services Modernization Act went into place, and what it did is it reversed the Glass-Steagall Act's prohibition of banks selling insurance or acting as investment banks. And this has also been known if you see it published anywhere, this reversal of the Glass-Steagall Act is known as the Graham-Bliley-Leach Act. So some other acts that have happened. In 2002, the Sarbanes-Oxley Act, that was enacted as a result of financial turmoil that happened in the late 1990s and at the turn of the century. And what that does is ensures that any external auditors, that they're offering fair and honest opinions when they are examining a company's financial statements. During that time or prior to this act, some auditors would offer, let's say, a positive financial report in regards to a company that really was on the edge of bankruptcy, and that was very misleading. So the Sarbanes-Oxley Act prohibits that from happening. And the SEC's authority was also increased to regulate financial markets in a bigger way than they were before. And the Dodd-Frank Act of 2010, that expanded the Fed's regulatory authority over non-depository financial institutions. So those are primarily savings and loans. It also established the Financial Stability Oversight Council to identify emerging risks. So when there's a market that can greatly influence the economy, such as the banking and the security industry, if they have overextended themselves, this group is an independent group to watch that so that the U.S. economy is not being put at risk. Now, on the securities markets, this is where stock is exchanged. Now, common stock is one type of stock, and we talked about that in a previous chapter, but it's your basic form of ownership in any corporation. With common stock, stockholders have voting rights, so you can vote in or vote for or against board members. You have the right to dividends if the company offers dividends and they have a profitable year. Capital gains, excuse me. Capital gains are received when the price of the stock goes over the amount that's paid for it. You might have preemptive rights, so the right to purchase more stock rather than someone who hasn't owned it before. And then you also have a right to a residual claim on assets should you decide to sue the company for some reason. It has to be a pretty big reason. There's also preferred stock. Now, with preferred stock, holders get preferential treatment. So they can make a claim on an asset. They also receive payment of dividends, and the preferred stock can be cumulative, so these stockholders can receive more over time. But what's interesting is that the company's stronger earnings do not ensure greater gains for the holder. So preferred stock holders are not issued dividends. So if the company has a robust profit year, preferred stockholders do not receive additional payment in the form of a dividend like the common stockholders do. Now, you also have bonds, and a bond is a formal IOU that's issued by a corporation or a government entity. Bonds have maturity dates. They have a par value, which tells you how much the bond will be worth when it has matured. The coupon rate, which is another term for the annual interest payment as a percentage of the bond's par value. And then the current yield, which is the bond's interest payment as a percentage of the bond's current market price rather than its par value. We also have, or can find on the securities market, convertible securities. So convertible securities are issued by certain corporations, and these are shares or bonds of preferred stocks that an investor can exchange to receive a number of common stock shares from this corporation. There's typically a conversion ratio where a certain number of common stock shares will be exchanged for each preferred stock. An example might be you'll get 2 common stocks for 1 preferred stock. And you also have the idea of financial diversification. And the idea behind financial diversification is the ability to own many different securities from different sectors. So owning common stock in the grocery industry, owning some preferred stock in the banking industry, owning some convertible securities in the automobile industry. So it's looking at a lot of different securities in different sectors. And the reason you would do that is to make sure that your portfolio is not too skewed in one direction should the economy tank. Now, mutual funds come in two basic structures. One is a closed-end fund, which issues a fixed number of shares and invests in the money received from selling them in a portfolio of assets. And then you also have open-end mutual funds, which also issue shares when demand increases, but they can also redeem old shares when investors cash in. And with an open-end mutual fund, those decisions are done based on the net asset value per share. Now, an exchange traded funds, this is a place that allows for the distribution and the creation of exchange funds through different mutual funds in different aspects. So investors can buy in one particular market, but they don't have to buy all of the market. Think of it as maybe a fruit salad where if you only want to buy the apples but not the whole salad, you can pick out the apples. So it's an idea that reflects the composition of a broad-based stock index, and it allows you to purchase on a slightly broader perspective. Now, primary security markets. Corporations raise additional financial capital by selling newly issued securities. And this can be done through a public offering where securities are sold to the investing public, so whoever wants to own stock in a particular company. And this can happen through what's called an IPO, or an initial public offering. And this is for the first time a corporation that makes its stock available publicly. Facebook did this a few years ago, and before that it was a private firm. And public offerings can also be underwritten, where an investment bank purchases all the shares at a specified price, guaranteeing the firm new funds. And this might happen if a company wanted to guarantee that they were raising a certain amount of capital. And when a public offering is made, these firms have to have a registration statement, and this has to be filed with the SEC. And it also has to include, when they're going public, the firm needs to turn in their financial statements. And then we have private offerings, and they're different from public because they're sold to one or more accredited investors. And these people are, they're either individuals or organizations that meet specific financial requirements that the SEC has set up. And there's usually terms that are negotiating between the issuing firm and the private investors. But the general public is not typically aware of these securities, and so we usually are not aware of them. Now, on the secondary market, you have the stock exchange, which is organized. It's an organized way to trade stocks and securities. And you've got your market makers who are security dealers who are always buying and selling NASDAQ specific stocks with an asking price and a bidding price. Let's see, we have over-the-counter market where securities that are not listed on exchanges are traded. So that's a different type of place than the NASDAQ or Wall Street. Then you have electronic communications networks, and these are entirely automated and computerized trading systems that let traders bypass the market makers that are used in the NASDAQ and the OTC markets. And buyers are able to make their transactions directly. So there are some ways that you can choose a broker. And a broker is someone who helps to facilitate the buying and the selling of securities. There is a full service broker, and the full service broker will perform market research for you. They'll offer investment advice and possibly tax planning. Now, discount brokers, they're different. They provide some basic services that are needed to trade in securities, but they don't offer quite as many services as the full service broker. And they tend to be cheaper than a full service broker. So you may want a full service person, and that's completely okay, but you will also pay for that service. Whereas discount brokers, you'll still pay a fee, but it's not nearly as high as the full service broker group. Now, when you're buying securities, you create what's called a market order. And this is where you instruct your brokers to buy or sell a security at the current market price. Now when you are providing these instructions, a lot of people also have what's called limit orders. And that is to give the buyer some boundaries. And when you set a buy limit order, that is saying, I want to buy a certain amount of stock at this price, but don't spend any more than $5,000. Or when the stock reaches a price of $50 a share, I want to buy it at that point in time. And the opposite is true for the selling limit order. That lets your broker know that if your stock has reached a certain price, when it gets there, you're ready to sell. So it's giving them some direction so that they're operating, with your interests in mind. Now, how and why do we invest in securities? Well, first, we invest for income. And when you're investing for income, you look at buying bonds, buying preferred stocks. You're looking for very secure investments that don't have a lot of risk, and you're really maintaining your portfolio value. You want to certainly look at the market timing and use analytical techniques to predict the fall and rise in prices of specific stocks. If you watch a stock and you see that the price is going up, 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 you may want to wait. It may be close to, what goes up comes down. And so if it's hitting record highs, you may want to wait until the price has gotten cheaper again. Another technique is using value investing, which is finding stocks that are undervalued in the market, and you would want to purchase those stocks to help generate a capital gain. And you can find out the value of stocks by using some of the price earning ratios that we talked about in the previous chapter. You want to look for investing for growth. So that is looking for companies that have the potential to grow, and they will be, over time, their stock will rise. It'll consistently rise over time. And a proven technique for investing is buying and holding. So some people like to trade, buy and sell, buy and sell, buy and sell. But another technique is to purchase the same amount of stock on a regular basis and holding them for long periods of time. So as the market goes up and it goes down, you're really in it for the long haul. Now, market trends and performance tracking. So on the stock index, it's really important to watch some large groups of stocks that meet a certain criteria. And we hear on the news all the time about the Dow Jones Industrial Average, and we'll hear, oh, the Dow Jones is up 500, the Dow Jones dropped 200. So what the Dow Jones is an adjusted average price of 30 stocks that have been picked by the editors of the Wall Street Journal. And these stocks are very strong indicators of what is happening in the economy, U.S. economy overall. So these are stocks that represent different markets, different sectors, but they combined, they give a good indication of what's happening on Wall Street. And then you find Standard & Poor's 500, and these are 500 stocks, and it is a much broader index than the Dow Jones because it has more stock, more companies involved. But these are 500 of the largest companies in the United States. And when the S&P goes up and the S&P goes down, that it's another very good indicator of where the economy is and whether or not it is strong and healthy. So to look at a specific stock, you want to type its symbol into a get quote box. And if you've ever looked at the business section of a newspaper, I know that sounds very archaic, but you will find each publicly traded company has an abbreviated name. For example, ConAgra Foods is, when you look on the stocks, they are identified as CAG. Procter & Gamble, I believe, is PNG. So you want to check out the company. You want to find out, well, what was the price of the firm's common stock for the most recent trade? You want to check out when was the last trade of the firm's stock. Is it traded regularly? You want to be looking for the highest that was paid and the lowest that was paid. How does the stock price change during the day? And you can see just wild, crazy ranges sometimes. Things happen on Wall Street and people can make millions in one day and they can lose millions. And then the market cap, what is the total market value of all shares for a particular time? It's also important to look broader term rather than just one day, but to look at how has the stock performed over a year, highest price in 52 weeks versus the previous 52 weeks. Volume, how many shares of the stock are being traded? Is it actively being traded? What is the stock's price to earnings ratio? And you find that out by dividing the stock's price per share by its earnings per share. The earnings per share is found by dividing net income by the number of shares outstanding. And you also want to look at the dividend that is given every year and whether or not has the firm maintained its dividend level in the previous year, or have they discontinued issuing dividends? So these are all indicators of, or just some things to be thinking about as you're looking to invest in stock. You want to choose wisely, and there are all sorts of analytical tools available to you so that you can make a good, solid investment and aren't just throwing money away at a company that won't be around next month. So looking back, we've looked at the role of the financial markets in the U.S. economy and identified the key players in these markets. We've identified the key laws that govern the way financial markets operate and explained the impact of each law. I've described and compared the major types of securities that are traded in securities markets. We've looked at how securities are issued in the primary market and then traded on the secondary markets. And we've brought this down to a more personal level and looked at several strategies that investors use to invest in securities and how to interpret some of the information that's provided in the stock quotes that are on financial websites. And some great financial websites are Morningstar, the Wall Street Journal, Kiplinger. Those are all fantastic resources. So now it is time to end this lecture. I thank you for tuning in, and please look to Buzz to see what your current assignments are. And remember to be on time. It's very important. This is a college class. And if you have any questions, please don't hesitate to contact me. Thank you so much. Bye-bye.